Hello options traders, and good morning to everyone in the group. And I just wanted to pass along a very helpful tip, especially for all of the new traders. And that is to beware of changing Greeks. You must understand that your Greeks change for all of your option positions all of the time, except maybe right at expiration. But prior to expiration, they are constantly changing. And if you're not aware of that, you're going to step into some very big traps. So for example, I'll hear a lot of times traders might buy the $100 call, let's say with a delta of 60. And they'll say, therefore, I'm going to pick up 60 cents for every dollar move in the stock. And that is absolutely not true. You're going to pick up 60 cents for the next dollar move. So if that stock goes to 101, yeah, you'll pick up about 60 cents. But if it goes to 102, you're going to pick up something different. And that's going to depend on gamma. So the point is that if you're not aware that they change, and probably more important, by how much they change, you can't manage the risk. So just remember that your Greeks are delta, gamma, theta, vega, and rho. These are really the 5 key ones. There are others to understand, but these are the ones that you really have to know. But regardless of which one you're talking about, they are sensitivity measures. They show how sensitive your options price is to some other factor. So once again, the thing that I want you to get from this video is to understand that your Greeks change by a number of factors, but primarily from changes in the stock price, time, and volatility. And if for no other reason, because of time, right? Time always moves. So if the stock stays exactly flat, volatility doesn't change, your Greeks are still going to change just because time passes. So as any of these change, your position Greeks change. So for instance, let's go back to the $100 call, let's say purchased at 2. This is your expiration graph. As I've talked about in many of the videos, we get the bend right here at the strike. So at expiration, yes, if the stock is below the strike, you have delta 0. And that's why this curve is flat. But if the stock is above the strike, even by a penny at expiration, you have delta 1. Those are the only two choices you get, 0 or 1. But that's not true prior to expiration. Prior to expiration, you're not on this blue curve. That's why it's called an expiration graph. Let's say if you've got 30 days to go, you're going to look more like this red curve. And notice that it's not either flat or on this 45-degree angle. It's curved. It's always changing. So if the stock is way down here, it's an out-of-the-money call, yeah, that delta is going to be pretty close to 0. If the stock is somewhere near the strike, going to be roughly a delta 50. And if the stock is way out here, it's a deep-in-the-money call, you might be pushing delta 1. But notice that the stock could be anywhere along this red curve, and that means it could be anywhere between 0 and 1. And as time goes by, this red curve is going to start slowly sinking towards the blue, so they're all going to change again. So even if you don't really understand the Greeks or understand intuitively what they might change to, at least understand that they change. That's going to pay very big dividends, because if you at least understand that, you can look at your broker's platform and it should tell you what your Greeks are, but you need to understand that that's why it's important to check them. So here's a trickier one. Let's take a look at a vertical spread. Let's say that you buy the 100 call and you sell the 105 call for a net debit of 3. So here's a question. Is your gamma positive or negative? Well, it's a little bit of a trick question, because this is what your risk graph looks like at expiration. So once again, get a bend at one of our strikes here at 100. We get another one here at 105. So notice that at expiration, you're either delta 0 if the stock is below 100, or your delta 0 if it's above your short strike of 105. But if you're somewhere between the strikes, you've got delta 1. So once again, at expiration, your choices are either 0 or 1. But prior to expiration, this is not the graph that you're sitting on. It might look like this. And so here's where it gets tricky. Over at the far left side, when you're closer to the long strike, you've got positive gamma and negative theta. And one of the ways you can tell is that this portion right here looks a little bit like a smile. kind of curving up towards the top of the chart. That's an indication of positive gamma. And that just means that your deltas are going to accumulate or increase as the stock price increases. But notice what happens if it goes above your short strike, right? If a long call has positive gamma, a short call has negative gamma. So if you're up in this region, you flip. You now have negative gamma and positive theta. So now it looks a little bit more like a frown. This curved portion is pointing downwards. And that's an indication of negative gamma. You're going to be reducing your deltas as the stock price rises. So one of the things that's interesting about this is that you, as a trader, can set up your position to have negative gamma, positive theta if you want. Put both options in the money. Or you could set it up to be positive gamma, negative theta if you're looking maybe for a faster aggressive move. However, just because you set it up that way doesn't mean it stays that way. You might set it up wanting positive theta, and then the stock falls down into here and you think, oh, good thing I set up my position to have positive theta. No, you don't. Not anymore. You now have negative theta. And so you're off doing certain hedges, rolls, morphs, trades, thinking that you've got positive theta when it's exactly the opposite. And that's because your Greeks changed as the stock price changed. So we can look at a gamma graph, and some platforms like Thinkorswim will show these to you. So notice that our zero line is right here, this horizontal line. So this is our vertical spread right here. So if the stock is around 100, you've got positive gamma. But if it gets up above 105, you flip, you've got negative gamma. So this is the thing that really makes the Greeks tough. It's really kind of a two-part training system. You need to understand the definitions and the basic mechanics, but then you need to understand that they change and get some really good intuition as to how they're going to change. Are they going to increase, decrease, go from positive to negative? You need to understand that. So the main thing I just want you to get from this video is to remember that your Greeks change. You need to account for changing Greeks. And if not, your strategies may perform very differently from what you'd expect. And you can't manage risk if you don't understand the Greeks. For anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and Strategy Lab, as well as a course on the Greeks. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.